Good morning. Thank you for joining today. It should feel more exciting to be in a global bull market, but once again, South Africa is missing out on the party. It certainly is tragic. I'm very happy to have Wessel Brandt with me today. He'll be taking us through an update on the Fourth Industrial Revolution Fund, which is certainly doing better than South Africa. So please stay tuned for that later on. I'm also presenting at the Investment Forum tomorrow in Cape Town and Wednesday next week in Johannesburg, and I hope to see some of you there. But let's start with a review of the markets in February. Wow. February was certainly quite an incredible month and driven by some incredible performance. NVIDIA's outstanding results renewed the bull market in AI and FANG stocks. The company saw revenue growth of 265% for the quarter and expects revenue to more than double over the next 12 months. Just an incredible story. So what's interesting is that we look back to the last time we saw a story that was this incredible in the US, and very similar company as well. Cisco in 1999 was selling all this shovels it could to anyone who wanted to mine at that time tech, basically the NVIDIA of 25 years ago. Back then, Cisco got to a price to cash flow of 62. Right now, NVIDIA is only on a price to cash flow of 42. So it could go another 50% from these levels. That said, it is pricing in a very rosy future. And we all know what happened to Cisco's share price after Y2K. So there's definitely some strong momentum, but also some caution there. The other remarkable performance in February was China. Admittedly, off a very low base and driven by government policies aimed at manipulating the market. Firstly, they try to ban short selling. Well, they put policies in place to ban short selling. They also put policies in place to restrict quant funds in the way that they can sell and buy in direct market access, particularly in auctions. And most importantly, they bought $57 billion worth of Chinese ETFs over the month. And they expect to be buying more going forward. So while not necessarily a sustainable fix for the economy, China is definitely trying very hard to support its market. And that drove emerging markets, which was also up very strongly for the month. But generally, if you look at this chart, I mean, very strong months in Rand terms. So very strong market returns in Rand terms for all funds. Around 8% for the world, around 8% for US, around 8% for Japan and EU. So if you were anywhere, you were generally getting about 8% in Rand terms from the developed world and even emerging world markets, except for South Africa, which saw in Rand terms, South African equities fall 2% and South African bonds fall 0.5%. So it is quite a month, fantastic returns from everywhere, a massive bull market and huge party, everyone rejoicing, except us poor South Africans who saw our value decrease even in Rand terms during the month of February. So tragic, as I said. And we'll be looking more at South Africa and the budget that happened in February when we get to the South African section. So having a quick look at the Sygnia fund performance, very much in line with the markets. You can see there, up number one was the China New Economies and New Sector ETF, having a nice return of 13%. FANG fund up second, up 12%. And then the Berkshire Hathaway fund continuing to have a very strong year-to-date performance, up 10% in the month of February. And that was on the back of very strong results, particularly in their core insurance business. And Warren Buffett put out his annual newsletter, which is always a great read. If you haven't read his annual newsletter yet, I highly recommend it. It is a wonderful read all around, just from a personal experience as well as a business experience. The Sygnia Berkshire Hathaway fund is now up to 240 million Rand, so that continues to grow, and that fund is open on our live platform. So if you are excited about Berkshire Hathaway, that fund is open for you to invest in. Looking at the 12-month view, very much a FANG story. The Sygnia FANG.AI equity fund, which used to be the Sygnia FANG Plus equity fund, up 80%, phenomenal return over the last 12 months. But very much a story of US exceptionalism over the last 12 months and Rand weakness. The Berkshire Hathaway fund up 40%, and then the Sygnia Atrix S&P 500 and Sygnia Atrix MSCI US, which are very similar funds, both up 35%. And coming in at fifth place, the Sygnia, MSCI, Japan, up a decent 31%. And some nice, strong returns from Japan, who are not as impacted by the various wars in the Middle East and Russia and Ukraine as Europe are. So Europe is slightly behind Japan in that performance over 12 months. But some very, very strong performance over 1 month and 12 months. Unfortunately, not one South African fund in that top 5 rank over 1 month or 12 months. So it's, again, tragic, but it is what it is at the moment. So let's look at the chart of the month. And this is a phenomenal chart. It really is a phenomenal chart. The MSCI World hit a new all-time high in February, driven by new highs in the US. So if you look at the chart on the right, the green line there, and this chart goes back to 1987 to 2024. So it's a very, very long-term chart, and a steady upward green line there representing the S&P 500, which has had a phenomenal return over those 30 plus years. But what is fascinating is the blue line, which is the Japanese Nikkei 225 index, which has only now, in February of this year, reached its 1989 high, 33 years to get back to its previous high. In yellow, you've got the Euro Stoxx 50 index, and that has taken 23 years. It has only just reached the highs of 1999. And it's quite a scary chart because equities are certainly the best asset class for the long term. But sometimes the long term is very, very long. 33 years to just get back to a break-even return shows the importance of diversification across different asset classes, the importance of diversification across different regions, and very important, the importance of valuations. It's not just what you buy, but certainly the price that you buy it makes a big difference. So in Japan, in 1989, they were going through a property bubble, and you could buy the Nikkei index at a PE of 62. That has now derated substantially to a PE of 22, and even that 62 was a bit dodgy in terms of whether it was a true number in terms of how some cross holdings were valued, but it has come down from 62 to 22. If you look at the Euro Stoxx in 1999, that was in a PE of 72, driven by a Y2K tech bubble. And there it was not Cisco, which is the US stock, it's very much Nokia. Nokia drove that index to all-time highs, for at least for the last 23 years, and took that index to a PE of 72. The Stoxx 50 is now on a PE of 14. So some huge devaluation. And it gives you some comfort if you're investing in Europe right now on a PE of 14. Certainly, you probably won't have to wait 23 years for a new high compared to a PE of 72. And likewise, Japan on a PE of 22, it's maybe, hopefully won't be 33 years before a new high is reached, given that it's no longer on a PE of 62. But some of the FANG stocks are certainly on quite high PEs. That said, the overall S&P 500 PE is not that high. It's on a PE of 23, definitely above its long-term average, but not certainly at crazy blow-off mania levels. But there certainly are some pockets which are looking expensive, NVIDIA in particular, but at the same time, it does have a very rosy future if it meets expectations that are priced in. So what drove the markets to these new highs? Because we've all been very worried. We've all been worried about a US recession. We've all been worried about slow growth, about high debt, about aging populations, about oil prices, about geopolitical risk. I could name 10 risks that we've all been worried about. And yet markets have climbed to new highs. They've climbed this wall of worries. Now, one of the big indicators of world health is the JP Morgan Global Manufacturing Index. And generally, when that's above the level of 50, it means the world is growing and stocks move up. And when that is below 50, it means the world is contracting and stocks fall relative to trend. Now, that index has been below 50 for the last 16 months, and it's only in January that it finally got back to the 50 level. So you would think, why, if that index has been in recession effectively for the last 16 months, are equities, why have they run so hard? And it really has been about COVID distortions. Now, COVID, we still are struggling from distortions that COVID impacted to the world, where everyone focused very strongly on goods. During lockdown, they bought TVs, they bought cars, they bought laptops, iPhones, Occasionally, some people bought Samsung phones, but mostly iPhones. And then the lockdowns ended. Everyone traveled and they went to restaurants and spent on services. And that led to a slowdown on the manufacturing side of the world, of the economy relative to services. And so this gauge that we've used, this manufacturing PMI, has been recessionary, even though services have actually held up the overall economy. But things have still been slow. And the US was the only economy that expanded in the fourth quarter of last year. It expanded at a great level of 3.3% in the fourth quarter of 2023, while the Eurozone, the UK, and Japan were all basically either in recession or stagnating. So very much a US-driven recovery last year. The thing about markets, though, is that they don't look backwards, they look forwards. And assuming that markets are efficient, and they are pretty efficient, they price in all the known knowns. So what changes markets is a change in expectations. It's a change in what is known. And that is quite nicely monitored through the Citi Economic Surprise Index. And if you monitor that index over 2023, you'll have seen the only economy in the world to have positive surprises that were beating expectations was the US. But more recently, in November and December and January of this year, those indices have gone positive, not only for the US, but also for Europe and also for Japan, showing that the whole developed world is now positively surprising, which means that markets can be supported, and that's helped drive these markets to new heights. Unfortunately, China, which was stagnating in 2023, their surprise indices have only just moved back to neutral, so nothing too positive, but at least no longer recessionary. So hopefully not a drag going forward. But things are looking better in Europe and Japan over the last 3 months compared to 2023, and that's helped drive our markets higher. And we stick with our consensus that we think that markets will continue to go higher this year, although they are looking quite stretched in the short term with a very, very strong start to the year. And some short-term technical indicators are flashing orange, as well as some indicators in the US, which I'll talk about. But let's focus on the US before I get to those indicators. Geopolitical risk remains high. It is definitely one of the biggest risks that I've highlighted. It's one of the things that we're worried about. It may drive oil prices higher, which will then drive inflation and cause central banks to keep interest rates higher, which will drive the world into a recession, potentially a deep recession. So far, the oil price has been well behaved, and we think it will continue to be well behaved, but we are watching this quite closely. We did see this month, in the aftermath of Russian opposition leader Alexei Navalny's death, the Biden administration unveiled a sanctions package against Russia. And that may have led to some economic uncertainty or some saber rattling, but so far nothing has happened yet, but it remains a risk. At the same time, we saw President Biden calling Putin a crazy SOB. So here we have Putin, we have Biden trying to show that he is still alive and trying to get some voters to support him. And that brings me to the US elections, which are getting closer and closer. Right now, the polls in mid-February have have Trump leading by only 1 point. So Trump is actually ahead in elections at the moment. Biden behind, which is very unusual for an incumbent president with the economy growing so strongly. And what is even more unusual is the level of unfavorability ratings right now, the highest ever in history for presidents at this stage of a race. 86% of voters find Biden too old to run. Well, at least he's young enough to call Putin a crazy SOB. 70% of voters think that Trump is too old to run. Now, you all know that one of the driving factors that I have for economics around the world is aging populations. But the US is really taking aging populations to an extreme with these two gentlemen running for presidency. It's also the Biden-Trump rematch on the 5th of November. It'll be the first presidential rematch in more than half a century. So a lot of firsts right now. First rematch in half a century. We've got incredibly unfavorable ratings for the incumbents. Very tight race at the moment with Trump leading by 1 point. And certainly, I think markets are pricing in a Trump victory to some extent. While if you look at the Trump-Biden policies, they actually are overall generally quite similar for the US. The big difference is how they're going to treat the rest of the world. And the rest of the world could definitely see some harsh trade tariffs and reduction in globalization happen if Trump comes into power. And I think that also has fed through into Chinese stock prices, emerging market stock prices, the strong dollar, and even a slowdown in Europe and Japan to some extent. So we, as the rest of the world, we're watching this very, very closely, maybe even more closely than some of the Americans will do, as it does have a big impact on our markets. So once again, geopolitical remains high, not just the wars in the Ukraine and Russia and the Middle East and Gaza, but elections. We've got our own elections in South Africa coming up, and elections in the US are certainly a big and important data driver for stock markets. So as I mentioned, US exceptionalism is what drove world growth in 2023, and certainly what drove US stock markets in 2023 and this year. The US has been incredibly strong relative to expectations, and that's been driven by the US consumer. The US consumer has been the spender of last resort, as they always have been, and they've kept the US afloat, and that's kept the world just out of recession. But we're starting to see some warning signs flashing around the US consumer. Credit card and auto loan defaults have risen, and the chart on the right is very, very important. This shows excess cash from the start of COVID, and how that has run out for 80%, or for households that are below the 80th income percentile. They've all run out of cash. So the green line and the yellow line, which shows households on the 0 to 40% income percentile level, and the green line, which is 48 to 80%, they now have less cash on their balance sheets than they did prior to COVID. So all those COVID savings that they had, all those checks that they cashed, the stimulus checks from the government, they're gone. And at the same time, we're now seeing that the household savings rate for the US in general is already low by historical standards. So there are no signs that the consumer can take on more credit, and they certainly don't have any more cash to spend. So I think we definitely are going to see a US slowdown coming. Now, we retain our base case scenario that the US is not going to go into recession, but a slowdown is definitely coming, and that's important. Further signs of that slowdown are quite evident. That US retail sales in January were the weakest since March last year, and disappointed expectations quite considerably. Similarly, US consumer confidence fell far more than expected in February. So we're starting to see a lot of warning signs coming through on the US consumer. Nice strong base, but definitely starting to turn lower. And we can see that feeding through into what I mentioned earlier, the US City Economic Surprise Index, which is still positive, but it's rolling over as well. So slowdown coming in the US, but growth is still on track. Why? Well, there's still some solid bases in the US. The one is that financial conditions have eased in anticipation of rate cuts. Two, household wealth remains elevated because of strong equity markets and strong property markets. Property markets have actually been relatively stable in the US. They've fallen a bit in terms of pricing, but not as much as it was expected. There's just a lack of supply. And we're starting to see renewed signs of growth, of investment in property in the US. And that's also leading to manufacturing recovering in the US. So some general green shoots in the US that are coming through as the consumer is starting to slow. So a very much a mixed bag in terms of economic news, and we think it'll keep the US out of recession, but we do think that growth is going to slow. Now, the markets have definitely been very buoyed by the strong US economic data. As that economic surprise index spiked, as strong jobs came through, as strong inflation numbers came through in January, the market moved from pricing in 7 cuts. In December, the market was pricing in 7 cuts from the Fed in 2024. It's now pricing in 3 cuts, which is in line with what the Fed is pricing. So that's quite important because it impacts the valuation of the dollar, impacts the valuation of US small caps, of US global property companies, everything that's geared to interest rates. And so although in December we saw very strong performance from US small caps, we saw very strong performance from US property stocks, the dollar weakened quite a lot, That's all reversed over January and February as the market caught up with the Fed. So now we're back to the market being aligned with the Fed, which is good because it means that that at least the market is aligned with the Fed. We've got Jeremy Powell speaking today and tomorrow. He's got some important things to say, and he might be talking about interest rates movements. We don't expect to have anything until the next FOMC meeting, and there we'll find out if they're going to reduce those 3 cuts to 2, which would be very bearish for markets, or we keep it in track for 3 as we move forward to see what comes up. And that's all very much data driven. We US January CPI was a bit weaker, was a bit stronger than expected, but US core PCE was in line. So everything's again a bit of a mixed bag. So for the moment, we're quite comfortable the Fed will stick to its 3 cuts starting in June. And the market will also stick to that process. But it might take a little bit longer before US exceptionalism actually starts to wane and the rest of the world can benefit from those rate cuts and start to pick up. So we do stick to our US overweight for now and stick to a stronger dollar. And despite all the value that is evident in emerging markets in Europe and Japan, it's going to be a little bit longer before we start to see the benefit of rate cuts impact those sectors. Okay, moving on to China, the other global behemoth that drives the world, although less than it used to. Here we have our favorite Elon Musk, and I'm not going to read through everything that he is CEO of, because that would take the rest of the 45 minutes. But he's here in terms of his CEO of Tesla. Now, NVIDIA has replaced Tesla as the darling of the world, and Tesla is certainly struggling, and it's definitely succumbing to Chinese pressure. Musk warned of Chinese car makers that if there are no trade barriers established, they will pretty much demolish most other car makers in the world. They are extremely good. So we've seen that. BYD, Beyond Dreams, Building Your Dreams in China has eclipsed Tesla as the largest global electric vehicle manufacturer, and Tesla is struggling to compete on price. To try and achieve cheaper cars, Tesla is building its cheaper next generation EV at its Mexico plant. And that's helped by a $153 million Mexican government incentive. But the trick here is that the Tesla plant in Mexico is going to use Chinese parts manufactured in Mexico. So China is still dominating the world when it comes to manufacturing and even EVs, but they're just shifting their exports to Mexico. So the value of Chinese auto parts made in Mexico and exported to the US reached $1.1 billion last year, up 15% from the previous year. 33 Chinese auto part manufacturers were registered in Mexico last year. And that's certainly a reaction that China has to put in place, because China's direct exports to the US fell to the lowest level since 2010. Now, China is very worried about what Trump may do in terms of tariffs, and they're restructuring the economy. They are making sure they can export to the largest global consumer in the world through other emerging markets, whether it is Taiwan or Korea or Mexico. They're setting up manufacturing plants around the world. So China is finding a way to get around those restrictions. But certainly those restrictions are having an impact on China and impacting their employment and the overall consumer confidence. So let's focus on China for a bit more specifically. We saw loan growth fall to 10.4%, which is still phenomenal loan growth. I mean, South Africa would be all too happy to have loan growth of those levels. But it is the lowest level since 2003, 20-year lows for loan growth, which tells the story of China slowing down. That said, they are pulling on levers and other indicators are turning positive. So net new social financing beat market expectations, 6.5 trillion yuan compared to 1.9 the month before. So I mean, that's 3 times higher. So that's quite a big number. And also, if you look at the chart on the right, that shows M1's, its real money supply in China, and that rose at the fastest level in 2 years. Now, this chart that's the M1 real is in orange, and the Bloomberg Commodity Index year on year is in blue. And you can see there that the M1 money supply in China leads Bloomberg Commodity Index quite substantially over a 6-month period. So an acceleration in that M1 is positive for commodity prices. And we do think that commodity prices supported by renewables and countries trying to get energy security are going to keep commodity prices at least level, if not a slight uptick, which should be good for resources, should be good for the rand and South Africa, but we have our own issues. Now, because China is slowly recovering, the problem is that it's unlikely to do a bazooka stimulus. And that is still not happening. China did cut their 5-year loan prime rate by 25 basis points, which is actually the largest cut ever. So not quite bazooka stimulus, but they're starting to pull triggers. And as I said, they're doing a lot to manipulate their own equity market to try and buoy consumer confidence. So the Chinese consumers have money in the property market, which is falling. They also have retirement savings in the equity market. So if China can get the equity market to rise, they're hoping it'll counter the negative wealth effect from the property market. So, and that should have some impact. We also have today, coming out fresh off the press this morning, is China's 2 sessions National People's Congress. We had Premier Li announce the 2024 GDP target, and he has said that China is going to target GDP of 5% this year, which, although it's the same as last year, is actually quite an aggressive target, and it's going to require some acceleration in the economy. So we are waiting and we're watching very closely to see if there are any specific and concrete ideas in terms of how they're going to achieve that, because if they are, well, then maybe we can start to be a bit more bullish on China. But right now, it's just a promise. And as South Africans, we all know that politicians are very good at promising, and execution is far more important. So we'll be watching that quite closely. That said, given that China is supporting their equity market, this is for the short-term traders out there. We're not making any changes to our positioning, but Alpine Macro Emerging Market Strategy, they're neutral on emerging markets, but within emerging markets, they long China. They've just put out a cyclical, tactical long on China, and they think that they've got 6 indicators that are all positive in the short term. They're still worried about structural growth in China in the long term. So this is not a long-term hold, but they do think that China is way too cheap, and they have identified some catalysts that they think could see a short-term balance in China. So for the short-term traders who are happy to take on some risk, you could buy the Sygnia MSCI China ETF. Now, I also saw that there was a technical analyst who put out a report on Business Day that from a technical perspective said that index, the Sygnia China ETF is actually a buy as well. So you can have a look at that technical report if you want to. But that's just for you short-term traders out there. I'm sure all the short-term traders are already long Bitcoin, and you've made so much money that you can retire. Unfortunately, I'm still a Bitcoin bear, so I've got extreme FOMO right now, as Bitcoin has achieved nearly 4 times growth over the last year. But that, and I'll talk about it when we get to positioning, it's just one of the things that is starting to worry me about markets, just the extreme moves that we're seeing. And it's not just Bitcoin, which potentially you could say is justified if we talk about the halving, but we've also seen Meta. Meta is one of the biggest companies in the world. It's covered by over 200 analysts whose sole job is to forecast their earnings. That company has gone up 5 times over the last 14 months. How does the 4th or 5th biggest company in the world go up 500% in 14 months? How wrong did the analysts have to get it, or how incredible is the change in expectations from AI? It's certainly something I've never seen in my 23 years of managing money. Nvidia is another one. Over the last 14 months, Nvidia is up 600%. Again, top 10, well, it's now top 3, but it was a top 10 global company. How did the analysts get it so wrong? How do you get such a massive change? Volatility is a sign of market tops. And while we may not be there yet, it is certainly one of the things that I'm watching quite closely and I'm a bit worried about. China is certainly not very frothy, so I'm not worried about that. I'm much more worried about the value trap that could exist within China. Okay, so while I'm talking about value traps, I should shed a tear, not smile. South Africa. So we had the budget speech on the 21st of February, and we had Finance Minister talking about our outlook and our budget. Now, the National Treasury did say that South Africa's government gross loan debt as a percentage of GDP is at its highest point since 1947. That is incredibly scary. The highest debt to GDP in South Africa's history from 1947. That definitely says that things are not looking good. And if we had spent that money, it's all about the debt multiplier. If we had spent that money and we'd got a return on growth, then it'd be worthwhile, because that high growth could then pay off that debt. But that money is just gone to corruption, to wastage, to who knows. So we've taken on this huge amount of debt. We've missed out on the commodity party. We've missed out on the global bull market party. We haven't got those tax revenues. We've had to take on more debt, and we haven't got the growth to grow out of it. So it's very concerning. And our finance minister and National Treasury are very concerned about our debt levels. So I suppose we should be happy that they're concerned. At least they're acknowledging that there's a problem, and that's certainly the first step. But seeing some sort of structural reforms is something we haven't seen for a very, very long time. Now, it's not just the high levels of debt to GDP that we have to worry about. We've got also a huge amount of debt that is due over the next 8 years. The rand value of debt that has to be paid back by the South African government over the next 8 years is 4 times the average over the last decade. We've got to find that money somewhere. The budget deficit this year rose by 36%. I mean, that is just a terrifying number in 1 year. And all that results in our debt service costs being at unsustainable levels. So the chart on the right, look, the orange line is the debt service costs of South Africa, and it's 21 cents of every rand of tax that South African government receives and that we pay goes to interest. And if you look at emerging market average, that's the blue line, we are more, sure, nearly 3 times that average and way outside interquartile range. So we definitely have an issue. And if you look back just a decade ago, we were sitting at 11 cents. So 11 cents, we were close to the average. We were within the range of emerging markets. Things were looking okay. But right now, due to poor economic growth, poor job growth, wastage, government corruption, we've had to take on debt just to keep the lights on. Well, we haven't even kept the lights on, just to pay wages, really. And I think that, to me, that's the biggest concern about the budget. There was no mention of structural reforms to grow the supply side, to make South Africa's potential GDP higher. Nothing. All our money has gone to paying social relief of distress grant, and it's gone to paying higher wage bills, and nothing structurally that actually we're not investing in our own growth. So we're just paying salaries. And not only that, but the Treasury, and the jury's out on whether it was a good or bad thing, but I think it's probably not a bad thing, considering how high our cost of debt is relative to some of our peers. But South Africa used half of our foreign currency reserves to bring our debt to GDP forecast down from 77% to 75%. I suppose it's a drop in the ocean, but I think it was a step in the right direction. Certainly, I think the only negative thing that people have to say about it is that there are concerns that having access to that money means that the rest of that money could be open to political maneuvering and could be used as well for things that aren't as good as debt reduction. So, but overall, not too bad in terms of that side. But still, South Africa, things are looking tough. SOEs have had negative ROEs over the last 5 years. SOEs have currently got negative cash flow. So we've got to put money into Eskom just to not keep the lights out. We've got to put money into Transnet just to not have any railway or port infrastructure. We've got to put money into the Postal Service and SAA to get nothing out. We've got to keep paying taxes for nothing. We're also on the FATF grey list, at least until February 2025, according to National Treasury. And then there's some big risks. Prescribed assets were mentioned. I'm sure that'll come up in the Q&A. NHI got over R1 billion funding. And the immediate concern is elections. The latest polls on average have the ANC at 42%, DA at 22%, and EFF at 16%. So foreigners rightly are very concerned. Foreign holders of South African equities has fallen from mid 40% to high 20%. So certainly South Africans have been left holding the market, but most South Africans, because of the 45% limit, have also taken their money offshore. So we're actually seeing the South African market looking incredibly cheap. The forward dividend yield on the South African stock market, based on Bloomberg, is the highest ever. So that is something. That means that we're definitely cheap. But what are the catalysts to turn that around? It's very, very hard to see. But right now you're earning a dividend yield of 5.8% on South African equities, and that should grow in real terms if South Africa's GDP can keep going. I mean, certainly we're not shrinking. We're growing at 1 or 2% a year. So if you're getting a 6% dividend yield plus 2% growth, it's an 8% yield return. It's not great. It's in line with cash, I suppose, and slightly below bonds, but at least it's more tax efficient for some investors. So there's definitely value, but no catalyst. So we remain underweight South African equities despite the value, and neutral South African bonds. Again, very, very strong value that is there, particularly compared to emerging markets, but some risks. And again, foreigners have reduced their holdings in South African bonds from also mid-40s, 40% down to mid-20s. And so foreigners have sold South African bonds, and it also is why they are much cheaper than they used to be. So yeah, there's a sale in South Africa. Buffett always says, be greedy when others are fearful and be fearful when others are greedy. But you also have to look out for structural concerns. And he learned to avoid deep value when he bought his textile mill, which eventually had to shut down. So is South Africa another textile mill? Most likely. Is China another textile mill? Positively. We don't know, but we do know that right now investors are focusing on anything with positive momentum, and that is AI, that is FANG stocks, that is US exceptionalism, and it's hard to see a catalyst for that to turn around. So that brings me to positioning. And here the story is a bit more positive than I've been saying, although markets are stretched in the short term, and although it's been a very narrow growth driven by US exceptionalism, we started to see green shoots in EU. This chart on the right shows German manufacturing PMI, which has picked up, and ZOO growth expectations, which have picked up. At the same time, we've seen Sweden's manufacturing, their new orders to inventory ratio. It's also a very good forward-looking indicator, also picking up. And as I said, the economic surprise indices in Europe and Japan and even the UK are picking up. So we're starting to see some green shoots in the rest of the world. So while the US is going from exceptionalism and slowing, the rest of the world is going from stagnation and to slight growth. And as long as that US doesn't slow too quickly, hopefully the rest of the world can continue. The big wildcard is China. If China can pick up its growth, that'll certainly support the rest of the world. I mean, the rest of the world is very much dependent on China. EU, UK, Japan, emerging markets, their biggest trading partner is China. It's just Mexico has its biggest trading partner is the US, and Mexico has obviously been doing very well, and Canada. So those markets have been supported by a strong US, and the rest of the world is close to or close to stagnation or recession. But yeah, so we need to watch China very, very closely, and today and tomorrow are very important to see. Actually, the policy meeting is on until the 30th of March. So we'll be watching the outcomes of that very closely to see if these green shoots in the rest of the world can continue and if the rest of the world can start to compete with US exceptionalism. But for now, no change to that view. Our strategic view remains unchanged. I think the cyclical trend is still upwards for equities. There's still time for the Fed to pivot and to start to cut rates. No US recession, but also no US acceleration. And what is good news is that inflation is likely to continue to roll over. So China continues to export disinflation. Shelter inflation in the US is likely to roll over. Oil prices are likely to stay relatively stable as non-OPEC supply continues to beat expectations. The one wild card is obviously geopolitical risks. And things there could escalate. It is amazing that we are in a bull market when 31,000 Ukrainian troops have died in the war. Russia's losses are estimated at 4 times that. And we certainly aren't seeing anything quieting down. And we'll have to wait to see what happens with the US and Trump, because that could have a big impact on that war. But we've also had Sweden has been officially given the green light to join NATO after Hungary's parliament approved its membership. And that may lead to some saber rattling from Russia. We'll have to see. Meanwhile, over 30,000 Palestinians have been killed in Gaza since the war started, and Israel has already made inroads in terms of its attack on the southern Gaza city of Rafah, with no evacuation plan of the over 1 million plus refugees there. So there's a lot of tinder out there that could easily erupt. But markets do climb a wall of worry. That is what happens. Until you see something different, until you see the oil price accelerate. And we're also watching the shipping containers in terms of the Red Sea cost, and that is coming over. So those amber flashing lights are something we're keeping an eye on, but not a concern. So right now we're keeping our position. We are excited about some green shoots in the rest of the world. We are worried about warning lights flashing in the US. Valuation remains a concern, but certainly if we are heading towards a mania in FANG and AI stocks, they could go up another 50% if 1999 was anything to go by. So while the momentum is strong, you want to hold on to your positions and keep an eye on them. So yeah, we'll be watching that very, very closely. Okay, that is it from the February market update. I'm going to hand over to portfolio manager at Sygnia, Vessel Brandt, who will be taking us through an update on the 4th Industrial Revolution Global Equity Fund. Next month, we have Anrich, who will be taking us through the Sygnia Enhanced Income Fund. So please join us for that. But for now, over to Vessel. Thanks, Vessel.
Thanks, Carl, and good morning, everyone. I would like to briefly update you on the process we run for managing the 4th Industrial Revolution Global Equity Fund, the unit trust version of the fund. The ETF version of the fund is a passive strategy and tracks the S&P Kensho New Economies Index, while the unit trust version of the fund is an actively managed strategy. And although the themes we use are the same for managing the fund, we also have access to the same sectors when building the fund's model. We've moved to a market cap base and away from the more equally weighted methodology previously used. This has proven valuable over the last 6 months, and we've added alpha over the index of nearly 7% up until the end of January 2024. The unit trust version will present much more like the NASDAQ 100, and although you get exposure to some great companies not listed on the NASDAQ exchange and therefore not in the NASDAQ 100 index, such as Visa, MasterCard, United Health, Novartis, and Toyota, and all these companies focus heavily on themes in the 4th Industrial Revolution. With the fund being an actively managed fund, the current model, which is based on underlying company market caps, would not be a permanent position, and we would look to increase exposure to smaller cap companies again once we are comfortable with US interest rates starting to come down. But with interest rates staying higher for longer, the large cap companies are proving more defensive, with stronger balance sheets, higher return on equity, and better profitability margins. And research also shows that 45% of the US small cap companies are having debt linked to floating interest rates, while only 9% of the S&P 500's larger cap companies having debt linked to floating rates, with the remaining 91% of companies having their debt linked to fixed rates. This makes the smaller cap companies a little bit more vulnerable in the period we are with higher interest rates, and therefore we find ourselves holding back on increasing our exposure to these small cap companies. But there will be a time when we would look to enter into these companies again. And with that, I would like to thank you. It was a brief update, but any questions, please email me and I'll get information right back to you. Thanks. Over to Carl again.
Thanks, Vessel. Okay, let's look at some Q&A. Clive asks, Carl, are you bullish on Eurostoxx 50 ETF for the long term for over 10 years? I'm thinking of investing in this ETF for my tax-free savings account. Clive, as I've said, we are underweight Europe in our portfolios. We do think that there are some headwinds to growth there in the short term because of Russia-Ukraine, because of energy risks due to the Middle East, all of which impacts Europe more than Japan and more than the US. That said, on a 14p, it's definitely much cheaper than other developed markets. And there are some fantastic companies in that index. So you are getting access to some fantastic companies at very good valuations. But in the short term, it may take some time before there's a catalyst to get outperformance of that index relative to other indices. But I definitely don't see anything wrong with, on a 10-year view, getting some exposure to some quality European companies from a growth perspective and an offshore perspective. So, yeah. But stay diversified and buy in tranches are my two holy grails when it comes to investing. Christopher says, what is the likelihood of Trump going to jail before a US election, in your opinion? Christopher, I think that the US court ruled yesterday or very recently that that probability is zero, that none of those charges are going to stop Trump from being on the ballot for the US elections. And I think once if he wins, then it certainly becomes a lot more complicated to put him in jail. So I think there's very, very little chance of Trump going to jail before the US elections. And while when we last spoke, Biden was leading that race, it looks like Trump is now leading that race, which is surprising, given the strong economy. But if the US economy is going to slow as we expect, well, that would be good for Trump, not as good for Biden. So we'll have to see. And their ages certainly don't help either of them, but Biden is the elder of the two. Mr. Naka, I agree with you that certainly China has some headwinds, particularly from a global trade perspective. If Trump does come into power, likely to see more tariffs. Yes, they are trying their best to export via Mexico and other emerging markets, but certainly there is a likelihood of China remaining weak if Trump comes into power, just in terms of a multiple perspective. And I agree with your point on fiscal support in the US. It is also slowing though. So while fiscal support was a big support of, along with the consumer in 2023 and during COVID, fiscal support in the US is slowing. That of course might also all change if the Republicans get the Senate and the House in November. And then we could see some very, very big spending in the US and some tax cuts, which would drive the US in the short term to new highs. Of course, long term, taking on more debt and cutting taxes is never a good solution. Johan asks about the budgets and ministers' view about adding infrastructure to Regulation 28 and the fact that there were comments that 45% level was too high in terms of relaxing foreign exchange controls for pension funds. So let me talk about prescribed assets while we're at this point. So I think that the probability of prescribed assets is very low. Right now, there's certainly no lack of demand for investing in infrastructure. Yes, the whole definition of infrastructure is a bit odd in Regulation 28, and maybe that needs to be revised and will be revised going forward. Right now, the Reg 28, 45% investment in infrastructure doesn't really change your behavior. That said, most pension funds and retirement funds that I'm aware of are eager to invest in infrastructure because returns are good and because it helps growth within South Africa. We only can have 45% offshore, so we want to help ourselves. And the pension public partnership is certainly one of the key ways of improving growth going forward. But the issue is not a lack of demand; it's just lack of supply. There's just so much bureaucracy and red tape and corruption that those renewable projects that we've been desperate to invest in are very, very, very slow to come to fruition. So while we're in this middle ground of no supply from an infrastructure perspective and lots of demand, there's just no need for prescribed assets. Prescribed assets are only there if people are unwilling to invest in infrastructure. And pension funds and retirement funds still have 55% of their assets in South Africa, and if they can get decent returns on infrastructure, they will certainly follow that. So I think that prescribed assets is yes, that's something that foreigners will be worried about, and it'll probably get way too much attention. I don't think there's a high likelihood of it happening. I'm certainly not concerned about that. I think there's still, when you're getting good returns out of South African bonds and there's a lack of supply of infrastructure, I can't see prescribed assets for either SA bonds or SA infrastructure happening anytime too soon, or any changes to Regulation 28. So that is one of the risks I'm not worried about. There are obviously many risks that I am worried about in South Africa. Keegan asks, what are your opinions around India? So India is a fascinating story. India's stock market, it all depends on which index you use, but if you use the Bloomberg index, India's stock market is now the 4th largest exchange in the world. I mean, that is quite something, and it's recently eclipsed the Hong Kong exchange. So that is shows that India has grown, but India has definitely grown from a multiple expansion. Investors have switched out of China, concerned that China is now centrally controlled, that it's not a free market, it's not an open economy, which has always been the case, but it's become a little bit more opaque. And so they are throwing their EM exposure into India, which is a bit more market friendly, although also still opaque to some extent. And there's been a massive re-rating in India. So and very, very good return. So most of the strong returns out of India have come through a PE rating as opposed to earnings. That said, they are making all the right sounds and doing all the right policy changes in terms of reforms to warrant the inflow of money. So investors are excited to get there because they can see that they will be looked after. So then you have to say, do you want to invest in India on a PE of 30, where markets are friendly, or do you want to invest in China on a PE of 10, a third of the valuation, where policies are unfriendly? And that's your debate. I certainly think a lot of the risk is being priced into both of those economies, and I think there are cheaper emerging market economies than India. Right now, Brazil or Vietnam or Greece all look more interesting to me than India. Hannah, thank you. Hannah says, when will we see a Bitcoin ETF? We'd love to have something, even if it's just a feeder fund into a BlackRock fund, but we are not allowed to. The JSE will not allow us to list a Bitcoin ETF. So unfortunately, nothing for now. And we are trying very hard. We're part of the JSE working group to try and get regulations changed. We will be the first to the market when it can be done, but we can't do it right now. So we're not able to participate in that 4-fold return on crypto assets, even higher in Rand terms. It's been quite phenomenal. Anton says, when is the presentation to Enhanced Income Fund? That is at the next webinar. So that'll be probably the first Tuesday in April. We haven't set the date yet, but that's whenever the next webinar is. our fixed income portfolio manager, Heinrich Diago, will be presenting an update on Enhanced Income Fund. And that is a great fund. So generally, if you look at, again, it's just a rule of thumb, and I wouldn't make any decisions on it, but if you look at calendar returns, your best returns from markets are November, December, January, February, March. From April to October, markets don't do as well, and they are obviously moving into election risks. So if you are looking into a more defensive positioning, enhanced income, you're getting 10.5% return. Yes, in rands, but we are in South Africa. 10.5% return with very little risks. And for those of you who are looking for something a bit more conservative as we go into our winter months, keep an eye out for that special guest next month. Robert says, what is the fee for our Stargazer product? Robert, I think you've caught me out on that one. I think it's 0.5%, but I'd have to double check. It should be on the fact sheets. Francois asks a question to Vessel, but I will reply for Vessels. But it's just asking for the difference between the fourth R unit trust and ETF performance. So there's two things that drive that, Francois. One is that our ETFs are priced when the market close at 5 o'clock, whereas our unit trust are priced at 3 o'clock, and you can have some big swings in terms of the currency and market performance. The other one is, as Vessel pointed out, 6 months ago, we restructured unit trust to focus on or be cognizant of market cap weights for its holdings, whereas Fourth Industrial Revolution is more of an equally weighted. So the ETF is more of an equally weighted constructed fund. So it's a size effect explains performance as well as some of the pricing. Peter says, Kyle, do you have some insights into the Bitcoin halving? How it impacts the Bitcoin price the longer term after the halving? Peter, I wish I knew. Everything I've read says the halving is supposed to be positive for Bitcoin. Everyone I know who is overweight Bitcoin was because of the halving, and they can expect that to continue to reduce supply to drive the price higher. What that impact on the price should be, and whether the price should be up 4 times, I don't know. I don't have a model to understand that exact dynamic. I did show a chart last month, which just showed the movement in the Bitcoin price after various liquidity was added. So when the futures were first offered, when Coinbase was first listed, and now the S&P, the iShares listing, BlackRock listing, the price generally did rally after that for a while and then retracted. So yeah, the Bitcoin is one of those, because it's like gold. You have some strategists who predict gold to be at $3,000 and others who predict gold to be at $1,000. And you've got some strategists that predict Bitcoin to be at $100,000 and others that think Bitcoin should be $5,000. Because there's no fundamental basis for it, you have to rely on demand being stronger than supply. And you can't predict that demand. So it's very hard to price. The gold, certainly, if you had to do the fundamentals, which is the cost of getting the gold out of the ground, well, then gold should be half the price it is. But because emerging markets are trying to move away from having dollar cash so that they can't have their assets frozen, that is supporting the gold price. And there's no way of knowing how long it's going to continue, and it could drive gold a lot higher. Right now, it's just a good question. I'm not sure what the mining cost is of Bitcoin. That mining cost will go up with the halving, but I doubt the cost of mining a Bitcoin is as high as the current price. So difficult to value. Terence asks, any new products coming out of Sygnia? Nothing that I can think of right now. The last product that we offered was the transnational fund, which has actually worked out incredibly well and has beaten the overall market quite substantially since its listing about 6 months ago, when we launched a live product. We also restructured our Swix unit trust to follow the transnational model. So have a look at that if you're trying to avoid companies that are linked to South African growth. But nothing else that I'm aware of that we're bringing to market anytime soon. Louise says the fourth industrial revolution is still closed to discretionary investors. Yeah, that is correct, Louise. The fourth industrial revolution unit trust is closed to discretionary investments. The fourth industrial revolution unit trust is not closed to RAs or to LAs. And for discretionary investors, you can still invest in the fourth industrial revolution ETF. So there are avenues that you can use if you want fourth industrial revolution exposure. The ETF is available for discretionary investors, and the unit trust is available to RAs and LAs. Complicated question about on what it means for South Africa to tap into the reserves in the long run. I think the jury's still out on that. I've seen a lot of research, and some of it, most of it, disagrees with each other. But the broad brushstrokes are that internationally, this has been done before. Internationally, our reserves were quite high relative to some of our emerging market peers. And so you can justify what Saab did in terms of using our reserves to pay down debt. To me, I think the cleanest thing is to look at if you have to raise debt at 11% and you're investing in offshore assets that are giving you, US cash, which is giving you 5%, well, you are going to be running a loss and you have to cover that loss. Yes, you've got some capital gains, but that is not always the case. So, to be geared where you've got negative funding is not necessarily the best thing. So I do understand that there is some reason to use some of those assets, and particularly as the Saab expects the rand to strengthen somewhat, and Bloomberg estimates also and strategists do expect the rand to get down to 18 over the next year. We'll have to see. Certainly, if we start to see US cutting rates in 6 months' time, the rand could recover quite nicely. But for the moment, there aren't any catalysts for that to happen just yet. Good question. It's good question. So, and I don't want to steal Unrik's thunder for next month, but the Sygnia Enhanced Income Fund did not have any exposure to the Bright taxi instrument. So that is very positive. No exposure to Bright taxi instrument in that fund. And it's a great fund, very diversified. Louise asked about the National Treasury using GFECRA account and the fact that they are going to sterilize that money, so it shouldn't be inflationary. That is the case, that they do say they will sterilize it, but I think the impact of that relative to overall bond issuance is negligible. So I do think that right now our bonds continue to be driven by the rand, and the rand is driven. The inflation in South Africa is driven by the rand as well. So it's all about, we're a small open economy. Yes, on the fringes, we can improve things if we can get transit working again, and we can start to export through our ports, and we can start to get our goods to our ports on the railways. And there were some good changes to transit in terms of leadership. So that bodes well, but that's on the fringes. When it comes to South Africa, we are at the mercy of China, at the mercy of the US dollar and US interest rates. So we get swung around by global flows. Agreed, Mr. Nike. Des asks for a feedback on the Sygnia OSE funds. I think, Des, we can definitely get a guest speaker on the webinar to give you an update at some point. Clive wants to email Vessel. I think, Clive, the best thing to do is just email admin@sygnia.co.za and ask to be put through to Vessel, and they will do that. If I give out Vessel's email address, he might never forgive me. Peter again asks about our contingency reserves, our forex reserves. Do reserves usually dampen volatility? Where might we risk more volatility because of depletion of the reserves? It's such a good question, and there definitely is not enough information on that. To what extent countries with high levels of foreign exchange reserves are seen to have the ability to manage FX volatility. So it's more the threat than the actual physical use of it. Just like Draghi said, he'll do whatever it takes, and he sorts it out the European Union without actually having to do anything. Having those high levels of FX reserves gives the threat that a country can use them. But whether any country could actually start to fight and protect its currency with its FX reserves is highly unlikely, particularly South Africa. I mean, 500 billion rand is a drop in the ocean in global terms. If the SARB tried to keep the rand strong by using that, people would quickly take that bet and win it. So yeah, I don't think that. Well, I don't think that those contingency reserves are actually that useful for South Africa, given that they need to be a lot bigger than they currently are in global terms for us to actually have any meaningful impact to reduce volatility in our FX environment. So that said, if they're not big enough to use, and you're not going to use them anyway, then we may as well reduce them. But it's just my view. Nick asks, where can we find Warren Buffett's speech? Nick, if you go to berkshirehathaway.com, that's the website. It's one of the more antiquated websites that you've seen. You will find a link there to the annual chairman's letter, and that will be Warren Buffett's speech. And it gives you everything that his thoughts over the last year, and he always has some interesting insights into various things. One of the things that he's been he likes to complain about is accounting reforms in the US. So there is a long spiel about accounting reforms, which you can skip if you don't want to. But yeah, he always has some very interesting insights. Dominic asks, where do I stand on the issue of side pocketing distressed assets? That's a good question, and there's definitely pros and cons, and I will leave the technical answer for that one to Ulrich. I suppose if I had to think about it, the best solution, we were aware of the able side pocket, which affected most industry. Bridge certainly luckily impacts less of the industry, but the more diversified you are in credit, the smaller your allocation to any side pocket, so that the better your overall outcome. So to me, when it comes to credit, it's diversify. Barbara says, will we get access to the recording of the session? Definitely. Every webinar that Sygnia puts out, and we put out a lot. I have my monthly webinar. Professor Haroon Borat, he also puts out a couple of webinars a month on broader economic themes. They're all on the Sygnia YouTube channel. So please, if you want to see what resources that are out there, have a look at our YouTube channel, and you'll get access to all our recordings. Yes, Mervyn. So unit trusts are priced at 3 o'clock, not 5 o'clock. And ETF prices are priced at 5 o'clock at market close. So there is a different price for an ETF as there is to a unit trust. So that is one of the differences between those instruments. Shane asks the differences in the Sygnia New China sector ETF compared to MSCI China ETF. So the New China ETF is based on the S&P index, and there they try to focus on new sectors. So those sectors that the Chinese government are supporting. So it's got an underweight to property, an underweight to banks, an underweight to resources, which are all seen, and property, which are all seen as old economy sectors, and an overweight to Chinese consumer, Chinese technology. So we do think that the Sygnia Chinese ETF should beat the overall MSCI China ETF because it's focusing on those sectors of the economy that the Chinese government is trying to support. Monique, I hope so. I hope we have something soon. Monique asks, she says, I'm currently invested in dollar portfolios through Easy Equities. Do you think Sygnia will have a similar offshore dollar platform in the near future where we can buy USD shares and ETFs? Definitely, it is the plan. We are launching our new platform soon. Then plan B is for 6 months later for us to have our dollar-denominated multi-currency platform, in which case we can then offer dollar-based products. You can, for discretionary investors, you can actually currently, if you're on the Alchemy platform, on the Sygnia platform, you can actually invest in a number of single stock dollar denominated, well, they're rand denominated, but you can get exposure through ETNs. So right now, if you are an investor on the Sygnia platform, you can buy Microsoft through our platform by buying the first round Microsoft ETN. So there are actually some dollar shares that are available in rand terms on our platform. But no, if you want direct dollar investing, you have to wait for our multi-currency platform, which will be soon, plus 6 months. Shane says, it's a good question. It's given how US tech has risen, would it be better to invest in an equally weighted S&P 500 ETF? Shane, that right now, if you have any cognizance to value, you want to invest in US small caps, which I suppose the next best thing is US equally weighted stocks. You want to invest in Europe, you want to invest in Japan, you want to invest in emerging markets, anything where you're cognizant of dividend yields or price to books or PEs, you want to somehow dilute those FANG stocks. Equally weighted S&P is one of way of doing it. But our view is there's still momentum in the US large caps because they have the strong balance sheets, because they've got the strong cash flows, because they have exposure to AI. Until there's a catalyst that changes that, well, that's place to be. But as you saw in December, when that catalyst arrives, that those market swings can be very, very, very dramatic. And so it might be better to start investing ahead of a time. But right now we're not investing in an equally weighted S&P just yet. We do have the Fourth Industrial Revolution ETF, which is an equally weighted tech US ETF, effectively, for people who want that exposure. Serena says the FANG ETF, is that open or closed for RAs? The FANG ETF is open for, the FANG Unit Trust is open for RAs. FANG Unit Trust is open for LAs. The FANG Unit Trust is closed for discretionary. But the FANG ETF is open for everything, RAs, LAs, and discretionary, except for tax-free savings accounts, unfortunately, because there's a performance fee, and so we can't, it's not eligible. So anything can buy the FANG ETF except for TSFAs. Shane says, given the low multiples of China tech, how do prospects for China tech ETF look in the future? Well, as I said, Shane, if you are brave, you can take a short-term view, which Alpine Macro put out in terms of a bounce in China tech stocks because of China supporting their own economy, their own equity market. But structurally, there's still some big concerns about China. We'll see what comes out in the Chinese policy review over the next 2 weeks. Pleasure, Clive. And that is it. Thank you very much, everybody, for joining. Thank you for your questions. Thank you for your time. I really appreciate the fact that you do log in each month and give us an hour and a quarter of your time so that we can share our views with you. So I really hope we see you next month. And we'll have Onrich, our portfolio manager on enhanced income. And if you have more questions on the Fourth Industrial Revolution funds, either the ETF or the unit trust, please email admin@sygnia.co.za and they will pass that on to the portfolio manager, Vessel, and he'll get back to you. Great. Have a good month, everybody. Enjoy the bull market.